Let's begin with a simple question. What if a single decision, made thousands of miles away behind closed doors, had the power to shake the market for one of the oldest metals on Earth? Right now, a quiet but seismic shift is unfolding inside the global economy. It is not loud, it is not trending on social media every day, and most people are completely missing it. One of the world's largest economies has just turned its back on American technology. Not with speeches, not with press releases, but with action. They are no longer buying, they are building their own. And that choice is sending shockwaves far beyond the technology sector into the very foundations of money, power, and the resources that will define the future. We are talking about advanced semiconductors, tiny pieces of silicon that sit at the heart of smartphones, artificial intelligence, data centers, and the modern digital economy itself. For decades, these chips symbolized American technological dominance. They were the crown jewels of global innovation, and for a long time, the world had no real alternative. But that era is ending, and here is the part almost no one sees coming. This story is not just about technology. It is not only about geopolitics or trade disputes. It is quietly creating the conditions for a historic surge in silver, a metal many people still think of as a relic, something ancient, something outdated. But silver is not a relic. It is embedded in the wiring of the modern world. It moves electricity. It connects systems. It powers the technologies that nations are now racing to control. And what is happening right now could push silver prices to levels we have not seen in decades. Some will dismiss this as hype, as clickbait, as another exaggerated market prediction. But what follows is not built on speculation. It is grounded in data, in real market behavior, and in forecasts coming from some of the most respected financial institutions on the planet. The real question is not whether the world is changing. That is already obvious. The real question is this. As the global economic order is rewritten, which resources end up at the center of that new system? To understand why silver may be one of them, we need to start where everything begins. With the technology war shaping this century, for years, advanced semiconductors sat at the very top of the global value chain. They were not just components, they were leverage. Whoever controlled the most advanced chips controlled artificial intelligence development, military systems, financial infrastructure, and the future of industrial productivity. And for decades, that control rested largely in one place. The United States. American semiconductor companies supplied the world with the most powerful processors available. From cloud computing to smartphones, from data centers to machine learning models, global technology ran on American-designed chips. This dominance was not accidental. It was the result of decades of investment, talent concentration, and an ecosystem that was almost impossible to replicate. But dependence creates vulnerability. And in geopolitics, vulnerabilities never go unnoticed. As trade tensions escalated and export restrictions tightened, access to advanced American chips became increasingly uncertain for foreign buyers. What was once a reliable supply chain started to look like a strategic liability, and that is when the calculus changed. Instead of asking how to buy more, the question became how to replace them. Recent directives from regulators in the world's second-largest economy made that shift unmistakably clear. Major technology firms were instructed to halt testing, cancel orders, and stop integrating advanced American processors into future systems. This was not a temporary pause. It was a strategic pivot. The message was simple and blunt: build domestically or fall behind. This decision was not driven by performance alone. In many cases, domestic alternatives still lag behind the most advanced American chips. But performance was no longer the only metric that mattered. Control was. In an era of sanctions, export controls, and weaponized supply chains, technological independence became a matter of national security. Relying on foreign suppliers for the core of your digital infrastructure was no longer acceptable. So, governments stepped in. Massive incentive packages were proposed. State-backed funding began flowing into domestic chip makers. Entire industrial strategies were rewritten around one goal: reducing dependence on American technology at any cost. This was not just industrial policy. It was economic warfare by other means. And once that line is crossed, there is no easy way back. Because when a country commits to building its own technological stack, it does not stop at chips. It restructures supply chains, it stockpiles materials, it secures inputs, it builds redundancy, and it prepares for a world where cooperation is optional and competition is permanent. That is the moment we are living in now. And this is where the story quietly shifts from silicon to something far more elemental. Because every chip factory, every data center, every electric system that replaces foreign technology requires something else to function. Conductive materials, real materials, materials that cannot be printed, licensed, or sanctioned into existence. This is where silver enters the story. Once that decision was made, the break was swift. This was not a slow unwinding of trade relationships. It was a cliff. One quarter, American chips dominated the market. The next, they were effectively gone. For years, a single American chipmaker held more than 90% of the advanced processor market inside the world's second largest economy. That dominance collapsed almost overnight. Market access was not reduced. It was eliminated. Analysts estimated billions of dollars in quarterly revenue simply vanished. A market worth tens of billions annually was no longer accessible. And the most important detail is this: that market is not coming back, because the replacement strategy is already in motion. Domestic chipmakers were not asked to wait until their products matched American processors feature for feature. Instead, the strategy shifted to scale. Use more chips working together. Build architectures that rely on parallel processing rather than raw single-chip performance. Accept lower efficiency in exchange for independence. It was a workaround, but it worked. Production plans were accelerated. Output targets were revised upward. Some domestic chip firms announced plans to triple artificial intelligence chip production within a single year. Investment poured in. Share prices exploded. Revenues surged by thousands of percent year over year, not because these companies were suddenly perfect, but because they were now essential. They were no longer just businesses. They were national champions. And behind them stood the full weight of the state. Subsidies, preferential procurement, regulatory support, guaranteed demand. The kind of backing that transforms an industry regardless of short-term inefficiencies. From the outside, this looked like a trade dispute. From the inside, it was a declaration of independence. For American semiconductor firms, the implications were brutal. Losing one of the largest markets on Earth is not a temporary setback. It forces restructuring. It constrains research budgets. It reshapes future roadmaps. And it signals to other countries that dependence on a single supplier carries real risk. So the ripple spreads. Once one major economy successfully decouples, others begin to reconsider their own exposure. The logic becomes contagious. If access can be cut off once, it can be cut off again. And no nation wants its digital infrastructure held hostage to geopolitical decisions. This is how fragmentation begins. The global technology ecosystem splits into parallel systems. Separate standards, separate supply chains, separate industrial bases. Cooperation gives way to redundancy. Efficiency gives way to security. And when that happens, demand does not consolidate. It multiplies. Two systems need what one system used to share. Two supply chains need what one supply chain once delivered. Two industrial ecosystems now compete for the same finite resources. This is the hidden consequence of technological decoupling. And it is the reason this story cannot be understood by looking at chip stocks alone. Because every parallel system being built requires massive physical infrastructure. Power grids, data centers, solar arrays, electric transportation. And all of it depends on a single, irreplaceable conductor: silver. For most people, silver still lives in the past. Coins in a drawer, jewelry in a box, a relic of an older monetary system that no longer matters in a digital world. But that perception could not be more outdated. Silver is not just a precious metal. It is the most electrically conductive element on Earth. No other material moves electrons more efficiently. No other metal combines conductivity, thermal performance, and reliability at scale the way silver does. And that is why it sits quietly inside almost every advanced technology we rely on today. Your smartphone contains silver. The servers that store your data contain silver. The charging systems behind electric vehicles contain silver. Solar panels use silver to capture and transport energy. Data centers depend on it to move enormous amounts of electricity with minimal loss. Silver is not optional. It is embedded into the physical infrastructure of the modern economy. And as technology becomes more complex, more electrified, and more energy intensive, silver demand does not shrink. It grows. This is where the story takes a critical turn. Because while demand for silver is accelerating, supply is not. The world has been running a silver deficit for years. Not a temporary shortage, a structural one. Since 2021, global silver consumption has exceeded production every single year. The gap has not closed. It has widened. Hundreds of millions of ounces have already been drawn down from above-ground inventories. Vaults that once held surplus metal are being quietly depleted. And unlike paper assets, once physical silver is gone, it does not come back easily. This is not about panic buying or speculative hoarding. It is about physics. You cannot build advanced technology without conductive materials. You cannot electrify transportation without silver. You cannot scale solar energy without silver. And when two competing economic blocks both race to build independent technological ecosystems, the pressure on that supply intensifies. This is why silver sits at a unique intersection. It is both an industrial metal and a monetary metal. It benefits when factories expand and when fear rises. It gains value when economies grow and when they fracture. Few assets in history have played that dual role as effectively. And right now, both forces are moving in the same direction. The technology war is not slowing down, it is accelerating. And every step deeper into that competition pulls more silver out of the ground, out of vaults, and into permanent industrial use. Which brings us to the most uncomfortable part of this story. What happens when there simply is not enough? The uncomfortable truth is this. The silver market has been running on borrowed time. For 5 consecutive years, the world has consumed more silver than it has produced. Not by a small margin, by a structural deficit that continues to grow. Each year, the gap is filled by drawing down existing stockpiles. Metal that was once safely stored in vaults, inventories, and reserves is quietly pulled into circulation and used up. And once silver is used in industrial applications, much of it is gone for good. According to industry data, the cumulative shortfall since 2021 is approaching 800 million ounces. That is nearly an entire year of global mine production simply missing from the system. No headline crisis, no dramatic announcement, just a steady depletion beneath the surface. This is not how healthy commodity markets behave. In a balanced market, higher prices bring new supply online. Mines expand, new projects are developed, production rises. But silver does not work that way. Roughly 70% of silver is mined as a byproduct of other metals like copper, lead, and zinc. That means silver production is not driven by silver demand. It is driven by the economics of entirely different markets. Even when silver prices rise sharply, mining companies cannot simply turn on more supply. New silver-focused mines take years to permit, finance, and develop. From discovery to production, the timeline often stretches 7 to 10 years. At the same time, ore grades are declining. The average quality of silver ore has fallen significantly over the past 2 decades. That means more rock must be processed to extract the same amount of metal. Costs rise, output stagnates, environmental regulations tighten, community opposition grows. The pipeline of new projects remains thin. Recycling helps, but it is not a solution. Even at its highest levels in over a decade, recycled silver accounts for only a fraction of global demand. And much of the silver used in modern electronics is dispersed in tiny amounts, making recovery difficult, expensive, or uneconomic. This creates a dangerous imbalance. Demand responds quickly, supply responds slowly. And while this mismatch would be concerning under normal conditions, it becomes far more serious in a world undergoing rapid electrification and geopolitical fragmentation. Because this deficit is not being driven by luxury consumption or speculative excess. It is being driven by essential infrastructure, solar energy systems, electric vehicles, data centers, medical equipment, power grids, technologies that governments are actively promoting and subsidizing, industries that cannot simply stop consuming silver because prices rise. When demand is inelastic and supply is constrained, the only mechanism left to balance the market is price. Higher prices ration scarce supply. Higher prices force prioritization. Higher prices signal the true value of what is being consumed. This is not a prediction. It is basic economics, and it sets the stage for the most powerful force in this entire story. Explosive industrial demand. If supply is the pressure point, demand is the accelerator. And silver demand is being driven by 3 forces that are not slowing down. They are speeding up. The first is solar energy. Over the past decade, solar has transformed from a niche alternative into a central pillar of global energy policy. Governments are racing to expand capacity. Utilities are locking in long-term projects. Corporations are committing to renewable targets that require massive build-outs. Every solar panel relies on silver. Thin layers of silver paste are applied to silicon wafers to create the electrical pathways that capture and move energy. No other material matches silver's performance at those thicknesses. Cheaper substitutes have been tested repeatedly, and they fail. Conductivity drops, efficiency falls, durability suffers. As a result, solar manufacturing has become one of the largest single consumers of silver in the world. In recent years, the solar sector alone has absorbed close to 200 million ounces annually. That number has more than tripled since the mid-2010s, and newer solar technologies are actually increasing silver usage per panel, not reducing it. Designs like heterojunction and TOPCon cells require silver on both sides of the wafer. Even as manufacturers try to thrift and reduce metal loadings, efficiency demands push consumption higher. Technology is winning that race. The second driver is electric vehicles. A traditional internal combustion vehicle uses silver in basic electronics. An electric vehicle uses silver everywhere. Battery management systems, power electronics, charging infrastructure, sensors, safety systems, high voltage connections. On average, an electric vehicle uses up to nearly twice as much silver as a conventional car. As global electric vehicle production scales, silver demand scales with it. Automakers are not choosing between silver and cheaper alternatives. They are choosing between performance and failure. Reliability matters, efficiency matters, safety matters, and silver delivers all three. With electric vehicle production expected to more than double over the coming years, automotive silver demand is set to rise sharply. The third driver is artificial intelligence and data centers. This may be the most underestimated source of future silver demand. Artificial intelligence is not software floating in the cloud. It is physical infrastructure, racks of servers, high-performance connections, cooling systems, power delivery networks. All of it requires massive amounts of electricity and precision conductivity. Global information technology power capacity has increased more than 50 times since the year 2000, and that curve is steepening. Every new data center is a concentrated node of silver consumption. Every artificial intelligence server relies on thousands of high-performance connections where conductivity and heat management are critical. And here is the feedback loop. Data centers consume enormous amounts of electricity. That drives demand for renewable energy. Renewable energy relies on solar. Solar relies on silver. This is not a single trend. It is a compounding system. Now add geopolitics. When two economic superpowers race to build parallel technology ecosystems, demand does not split, it multiplies. Both sides need their own solar capacity, their own electric vehicle supply chains, their own data center infrastructure, and none of it works without silver. This is why the silver deficit is not cyclical. It is structural, and it is why the market cannot resolve itself quietly. Something has to give. At this point, many people assume the solution is obvious. Higher prices will bring more supply. That logic works for many commodities. It does not work for silver. Silver supply is unusually rigid. It does not respond quickly to price signals, and the reasons are structural, not temporary. As we've seen, most silver is not mined because companies are looking for silver. It is mined because they are extracting copper, lead, or zinc. Silver comes along for the ride. That means even a dramatic rise in silver prices does not immediately incentivize new production. If copper demand weakens, silver supply falls, regardless of how high silver prices go. On top of that, building new mines is a slow process. Exploration budgets were slashed during previous bear markets. Many promising deposits were never developed. Permitting timelines have grown longer. Environmental standards are stricter. Political risk in major producing regions has increased. From discovery to production, a new silver mine typically takes close to a decade. There is no quick fix, and existing mines are facing their own challenges. Ore grades are declining across the industry. That means miners must process more material to extract the same amount of silver. Costs rise. Energy use increases. Profit margins compress. Some operations become uneconomic even at higher prices. This is why global mine production has remained essentially flat. Even as demand surged and prices climbed, output barely moved. Recycling is often cited as the release valve. And while recycled silver supply is expected to reach its highest level in more than a decade, it does not change the equation. Much of the silver used today is locked inside electronics, in quantities too small to recover efficiently. Recycling helps at the margins, but it cannot close a deficit measured in hundreds of millions of ounces. This creates a dangerous imbalance. Demand moves in real time. Supply responds over years. So when demand accelerates suddenly, as it is now, prices must do the work of rationing. Higher prices force difficult choices. They determine which industries can afford silver and which cannot. They slow consumption at the margins. They incentivize substitution where possible. But for many applications, substitution is not an option. Solar panels cannot function without silver. Electric vehicles cannot meet performance standards without silver. Data centers cannot operate reliably without silver. These industries do not walk away when prices rise. They absorb the cost, and that means price pressure continues upward. This is the moment when silver stops behaving like a quiet commodity and starts behaving like a strategic resource. And when that happens, investors start paying attention. Whenever uncertainty rises, human behavior becomes predictable. Capital looks for safety. Throughout history, during periods of economic stress, political tension, and currency instability, investors have moved toward assets that exist outside the financial system. Assets that cannot be printed, assets that do not rely on trust in institutions, assets with a physical presence. Precious metals sit at the top of that list. In the current environment, those forces are back in full view. Trade tensions have intensified, tariffs have expanded, supply chains have been disrupted, and confidence in long-term monetary stability has weakened. Central banks responded with rate cuts. When interest rates fall, the opportunity cost of holding non-yield assets disappears. Precious metals become more attractive, and silver, in particular, benefits from this shift. Unlike gold, silver is accessible. It allows investors to enter the precious metals market without the high capital requirements of gold. That lower barrier has driven strong retail demand. Physical silver coins, bars, and exchange-traded products have seen sustained inflows throughout the year. But silver offers something gold does not: dual identity. Gold is primarily a monetary asset. Silver is both monetary and industrial. That means it benefits from fear and from growth, from instability and from expansion, from crisis and from infrastructure build-outs. This is why silver often outperforms gold during inflationary and reflationary periods. There is also the matter of valuation. The gold-to-silver ratio measures how many ounces of silver it takes to purchase 1 ounce of gold. Historically, that ratio has averaged much lower than where it sits today. When the ratio stretches too far, it tends to snap back, and when it does, silver usually moves faster and harder than gold. Investment flows reflect this dynamic. Silver-backed exchange-traded products have absorbed hundreds of millions of ounces over the past year. Holdings have climbed to levels not seen in years. Physical market tightness has become visible, with rising premiums and inventory stress in major trading hubs. At the same time, central banks have been quietly shifting reserves away from traditional currencies and toward hard assets. While gold remains the primary focus, the broader trend supports precious metals across the board. And looming over all of this is the realization that the risks driving these flows are not temporary. The technology standoff between major powers is not a short-term dispute. It is a structural realignment. The world is fragmenting into competing economic blocks. Cooperation is giving way to redundancy. Efficiency is being sacrificed for security. In that kind of world, assets that sit outside political control gain value. Silver has served that role for thousands of years. It was money long before paper currencies existed, and in times of uncertainty, people return to what they trust. This is why investment demand is not fading. It is building. And it brings us to the question everyone is asking. How high can silver actually go? To answer that, we need context. As we speak, silver is already trading at levels that would have seemed impossible just a few years ago. It has more than doubled from its lows. It has broken through long-standing resistance levels, and it has done so while most of the world is still not paying close attention. That matters, because major moves in commodities rarely end where public awareness begins. They usually end where public participation peaks. Analysts across the financial world have taken notice. Forecasts that once seemed aggressive are now being revised upward. Targets that sounded unrealistic are now discussed openly in institutional reports. Some projections place silver in the $70 to $80 range within the near term. Others extend further, suggesting that triple-digit prices are achievable as the decade progresses. Not because of speculation, but because the math begins to leave no alternative. Consider the forces at work. First, the supply deficit has not closed. 5 consecutive years of shortage have already drained a massive portion of above-ground inventories. Each additional year compounds the problem. At some point, the market shifts from abundance to scarcity, and when that threshold is crossed, price movements accelerate. Second, industrial demand is not slowing. Solar installations continue to break records. Electric vehicle production keeps expanding. Data centers are multiplying to support artificial intelligence growth. These trends are happening now, not in some distant future. And none of them function without silver. Third, investment demand remains strong. Retail investors continue to accumulate physical metal. Exchange-traded products keep absorbing supply, and institutional capital is increasingly viewing silver as both a hedge and a growth asset. Fourth, monetary policy remains supportive. Lower interest rates reduce the opportunity cost of holding precious metals. Currency debasement concerns linger, and confidence in long-term fiscal discipline is fragile. Finally, there is geopolitics. The global economy is no longer moving toward integration. It is moving toward fragmentation. Nations are prioritizing self-sufficiency. Strategic resources are being stockpiled. Trade is being weaponized. In that environment, tangible assets that function across borders gain importance. Put all of this together, and the path becomes clearer. $100 silver is not a fantasy scenario that requires extreme assumptions. It is a logical outcome if current trends persist. It represents price adjusting to reality. Supply meeting demand under conditions of constraint. That does not mean the journey will be smooth. Silver is volatile. Corrections will happen. Pullbacks will test conviction. Markets rarely move in straight lines. But the direction is shaped by fundamentals. There are risks, of course. A severe global recession could temporarily reduce industrial demand. A sudden resolution of geopolitical tensions could ease safe haven flows. Unexpected technological breakthroughs could reduce silver usage per application. But none of these negate the core imbalance. Even conservative scenarios struggle to close the gap between what the world needs and what it can produce. And that is why $100 silver no longer sounds radical. It sounds plausible. So where does that leave us? What we are witnessing is not just a move in a commodity price. It is a shift in how the global economy is organized. For decades, the dominant model was integration. Supply chains stretched across continents. Countries specialized, traded, and depended on one another. Efficiency mattered more than resilience. Cost mattered more than control. That era is fading. What is replacing it is a world of competing systems. A world where technological independence is treated as national security. Where critical materials are no longer just inputs, but strategic assets. Where governments are willing to sacrifice short-term efficiency for long-term sovereignty. In that world, the materials that power modern life become incredibly valuable. Silver sits at the center of that reality. It is in the phone in your pocket, in the car you drive, in the electricity powering your home, in the servers storing your data, in the medical equipment keeping people alive, in the solar panels and power systems that governments are racing to build. Silver is not obscure, it is foundational. And yet, most people have no idea how dependent modern civilization has become on this one element. That blind spot is part of why the supply deficit has been allowed to grow quietly year after year. This is not an abstract imbalance on a spreadsheet, it has real-world consequences. If silver becomes genuinely scarce, it does not just mean higher prices. It means bottlenecks, delays, trade-offs, slower deployment of clean energy, higher costs for electric vehicles, constraints on data center expansion. You cannot have a modern, electrified, digital economy without silver. And when two superpowers race to build parallel technology ecosystems, demand does not ease. It compounds. That is the fundamental insight behind the bullish case for silver. Not hype, not speculation, structure. Now, to be clear, this is not investment advice. Markets are unpredictable. Prices can swing sharply. Everyone's situation and risk tolerance is different. Anyone considering financial decisions should do their own research and consult qualified professionals. But the forces we have discussed are not hypothetical. The technology standoff is real. The supply deficit is documented. Industrial demand growth is measurable. Monetary and geopolitical pressures are visible. These are not predictions about the future. They are descriptions of the present. And when constrained supply meets expanding demand, prices rise. When monetary conditions favor hard assets, prices rise. When geopolitical uncertainty pushes capital toward tangible value, prices rise. When all of those forces align at once, something significant tends to happen. Silver is no longer just a precious metal. It is becoming a strategic material for the future economy, a bridge between energy, technology, and money, a quiet constant in a world that is rapidly fragmenting. Whether silver reaches $100 next year or later in this decade, no one can say with certainty. But the direction of travel is becoming harder to ignore. In a world defined by competition, electrification, and uncertainty, silver is no longer on the sidelines. It is moving to the center of the story.